Well, you're not from Melbourne, but still, Aussie part. How are you guys? Perfect, perfect. Well, my name is Jordan, and today we're set for a real eye-opening presentation, guys. One of our club members, who's a real master when it comes to trading patterns, is going to show us, well, not all of his secrets. I'm sure he has still some secrets left up in his sleeve, but I'm sure many have already benefited from his advices and his contribution in the Telegram groups. I'm pretty sure you know who I'm talking about. In our world of trading, we call people like him real true veterans, okay, in the trading world. I'm basically going to stop here. I'm not going to give you any more clues or details about him. I'll let him do the honors of introducing himself in his background, basically. So, guys, without any further ado, I'm passing the mic and the screen to Mr. Peter. Hello, Peter.
Hi, Jordan. How are you?
Very, very, very well.
Okay, guys. Good morning. Okay, what we're going to cover today, a little bit about myself. Vlad asked me to do stuff on risk management, trade management, money management overall, so we're going to cover a fair bit of ground through that. Different types of management, whether the stop loss usage or no usage is preferable, multiple targets, position sizing. Then we're going to be putting the risk management and the trade management together in actual examples that have actually been traded. So I hope you enjoy it. Come up with any questions you've got, and we shall work to answer as many as we can, but we're going to coordinate all the questions at the end and put them into a manual that will accompany the webinar. So, a bit about myself. I commenced trading on the Australian Stock Exchange, working in the top 300 shares only on weekly charts in September '99. I added, I didn't put in there, I switched to CFDs in 2004. Then I added FTSE 350 and S&P 500 in 2007. Then switched to added futures, in October 2010. And then trading went to Forex additionally in March of 2012. But I've specialized in patent and patent identification during the whole period of time, since 2001. So identifying specific entry criteria and setup structures with the express intent of greatly increasing the probability of success. There's a lot of stuff written on patterns out there. A lot of it's rubbish. A lot of it is so vague that it's very difficult to make it work. My intent was to make it more highly specific and much higher probability of success. And I've gone to one slide too far. Wrote a book on trading patterns in 2014. I've delivered patent trading education to major brokerage houses in Australia, and I've lectured internationally on patent trading from 2010 through to 2014. So, yeah, a long journey, nearly 20 years. Nothing said here is going to be an absolute do or do not. It's got to be taken the concept of what I found works best for me. And my background is trend trading. Trend trading on weekly time frames. This had a huge influence on how I manage trades and work with exit strategies. I do work with multiple exit strategies. I don't have a single method of stop loss management. I have several different techniques that I use, frequently more than one on a chart at any point in time. And my stop loss that is actually enacted on the platform is the one that is closest to the price action from the multiple ones that I use on the screen at the time. Now we're going to be covering a lot of material today, guys. Excuse me. So please ask any questions you go. We will be pausing periodically to answer them, but we're not going to be able to answer them all. We encourage you to send in any further questions you have after the presentation to the support team. I will be receiving and coordinating all questions from the webinar and putting them and answering any unanswered ones. And we're going to be putting them into a question and answer manual, which will then be available on the website as part of the webinar structure as well. So a lot of this is going to be new to people. Some of it's going to be repetitive for some of you already, but it's quite in depth and there's a lot of material to cover. So I hope you take as many notes as you can. But like I said, write any questions you forget to ask, please send them in. We'll get them into the manual anyway. Money management is a bandied around term. It's an all-encompassing term. It includes risk management, trade management, account management, and overall investment management. It's all part of what is loosely termed as money management. Risk and trade management are the two areas we're going to deal with here specifically today. Risk management gets back to how much risk. Sorry?
Yeah, sorry to interrupt you, but
hello?
It's either the screen is lagging or we're seeing the old PowerPoints, the previous one. So maybe you need to fast forward. We're currently seeing the questions.
Okay. I'm
Yeah.
on slide 6.
Basically, what you see on the big screen is what we are seeing, all right?
Yeah. And I've just switched over to the next slide, money management. Does that not come up?
All right, just give it a second. I'm still seeing questions.
Okay, I'm up on the next slide. It's come up. Next slide's up on my computer at the moment.
Sorry, guys. What slide do you see at the moment? Is it questions?
I've got money management, which is the slide after questions.
Yeah, everyone is still seeing questions. So maybe go one. Yeah, there you go. Now we see money management. Now it's good. Now we're all on the same page. Thank you. Sorry for
let me know. Okay, what I'll do is I'll let you know that I'm changing slides. Let me know if it doesn't come up quickly.
All right.
So risk management is the amount of risk applied to each individual transaction or each currency pair, right? Or each new pyramiding position. So the risk is basically how much you're prepared to lose. What's the maximum amount you're prepared to lose on each transaction? And that's your capital at risk. Trade management is how we handle each opportunity. What method of entry we're using, what method of stops we're using. When we change from one to another, when do we enter new trades? When do we pyramid into successive trades? Now, the term pyramiding might be new for some people. Once you open a transaction, that doesn't mean it's the only transaction in that run, especially in trends. In decent length trends, as you're going to see in a couple of the examples, you might get 2, 3, 4 positions that all open up in that same pair before you get an exit signal. It's just that opening a new position is commonly called pyramiding. It's pyramiding into a new position. And that's what I mean by that. So with trade management, we've got to look at how we're going to enter. What specific criteria are we using to enter the transaction? How we're going to handle it once it's entered, where we're going to enter with an existing initial stop. When are we going to move that stop? How are we going to manage the stop, the trailing stop during the duration of the trade? And how do we handle the going into new positions during the whole duration of the trade before we actually receive an exit signal? That's all going to, those two areas are the ones we're going to be concentrating on. Account management is generally looked at as how we're allocating our account funds for trading, and overall investment management is much more like financial planning. It's how what funds are we allocating to our trading, what to investing, what to cash at bank, what to property, luxuries, etc. Those two areas we are not going to be going into. Just changing slides now to risk management. Any questions so far, guys?
Yes, seems no questions. We just allow a seconds for the people to type, but basically they're so clear. So I guess we're good to go.
Have you got the next slide up? Risk management?
Now we got it, yes.
Okay. I've long said that the primary concern of traders is to protect capital at all costs. Profit is a secondary concern. Many might disagree with that, but if you don't keep your capital, profit is a much reduced issue. We're going to go into a table that I call the cool mathematics of trading on the next slide. Risk management is about exposure of capital per transaction and exposure per currency. We'll get into a bit more on that in a minute, but most people don't consider the amount of exposure per individual currency. They more consider exposure or risk management per pair. Risk management is about limiting and controlling risk to the best extent possible. Now, that's not minimizing the actual profitability that you can take. It's about defining the maximum amount of capital you're prepared to risk on a transaction and adjusting your position size to that in some way, shape, or form. So we're looking at risk management per transaction. It's generally accepted that in a lot of documentation that the maximum risk per transaction should be in the vicinity of 2%. Many people take that as an absolute, that every transaction must be 2% risk. They forget that the concept of it is 2% is a maximum amount of capital at risk. And many experienced traders go vastly less than 2%. I know guys that have been around 20 or 30 years that won't risk any more than 0.5% per transaction. It's got to get back to your own risk tolerance, what you've proved to yourself that you can do as far as reliability. Also, that gets back to the maximum amount of drawdown that you are prepared to handle or can handle psychologically. And that is a very, very, very serious part of trading. It's the psychology of handling drawdown. Too many people have a good run of winning transactions, and it goes to their ego, and they start thinking they're a super trader. At the end of the day, if your success ratio is 7 out of 10, and you have 21 winning transactions, 9 losing transactions are ganging up to jump on you, and usually they will. That's the psychological impact of that run of losing transactions and what it does to your trading account, the drawdown from what you've grown it to back to what it ends up. And that's all a big part of minimizing your risk per transaction. Risk management per currency is something that most people actually forget about. They don't consider it. And what I mean by that is that many people are happy to have, for example, 1% or 1.5% or 2% trade risk exposure per transaction. But when you've got, for example, one transaction on Australia USD, another one Euro USD, another one New Zealand USD, another Pound USD, and USD CAD, USD Franc, and USD Yen, you have now got 6 individual transactions all exposed to the US dollar. If you're running at 2% trade risk per transaction, you've now got 12% of your account balance is exposed to a single currency called the USD. Let that sink in for a moment, guys. Most people do not consider that. It is a vital part of risk management. People defending their positions will say, well, what's got to do with the Aussie dollar or the euro or the pound or the CAD or the franc or the yen. It's also got to do with the USD. If it has a cough, then you suddenly got a bad cold in your account. Be very, very, very careful on that. Look at the maximum amount of risk you are prepared to attach to a single currency. If you get multiple signals within that currency, I personally would divide the amount of risk per transaction by the number of signals you get to the maximum amount of capital you're prepared to expose to that currency. Please let me know if that makes sense.
Positive.
Sorry?
Yes, that's a positive. That's an yes.
Yep. It's also, like I said, it's a thing that many people don't consider. Now, the risk management of pyramiding into positions. So let's say you've got a position open on the, well, we're actually going to go into the pound New Zealand later anyway. So on pound New Zealand, so you get a position open on the pound New Zealand, then you get another signal for a new entry. Do you take that signal? What's the maximum amount of risk in exposed to the second signal? This is all linked back to how much capital you're prepared to risk on the transaction and where your stop has been moved to, or if it's been moved since the original transaction opened, since the original entry occurred. So if you've got an entry that's occurred and you haven't been able to move your stop before the second signal occurs, you need to have the discipline to not take the second signal, because then you are increasing the maximum risk that you are prepared to take. Does that make sense? If you've been able to halve the trade risk of the initial position, then you should be able to take a similar size position to the half position half of what you've already taken. If your stop loss is currently in profit, then you can take a full size position off the next entry that comes up. On long trends, you will frequently get 3 to 4 entry signals. Why miss out on those extra positions and that extra profitability by not being prepared to take those? Too many people get into a position, get into a trade, and just close their eyes and don't look for new positions coming up. It's a very pyramiding is a very profitable methodology, but you need to be prepared for it. Do we have any questions so far?
Yes, just one question coming from Clive. What's your advised risk per currency?
I'm sorry?
What is your advised risk per currency?
Well, to me, if you're having multiple transactions on the one currency, I take that as the same as having a single transaction. I'm only prepared to risk the same maximum amount across the currency. So if I get two or three signals on, say, the US dollar, I divide that by the total transactional risk I'm prepared to take. But that's me. But again, you've got to do what you're comfortable with. What most people don't consider is that if they've got multiple positions, say on the US dollar, they are increasing. They're taking the maximum transaction risk per order, but they're not considering that they've got, say, 3 or 6 positions on the USD, which gives them 6 to 12%, for argument's sake, open risk on a single currency. To me, that's totally unacceptable. If it goes, if the Fed makes a big announcement, bang, it takes out all 6 entries and stops, you suddenly lost 12% of your account. That is demoralizing, guys. For anyone who's never been there, that is a severe psychological issue to deal with. Now, I'm not going to get into the deep into the psychology of trading. It is a complete subject on its own, but you've got to consider the impact. If you have a 12%, 15%, or 20% drawdown on your account, how is that going to affect you? How is it going to psychologically affect you? You've just lost 12 to 20% of your actual money. It's a sobering thought. And it will happen. But you've got to be prepared for it.
All right, thank you. One more question. What if one is short position and the other one is long position? And I think here Matthew is touching the subject of hedging and correlation, whether this is positive correlated or negative correlated.
Well, if, for example, you've got Aussie CAD going in one direction and USD CAD going in another direction, Aussie CAD are both mining mineral economies. So they are very highly correlated. And they can be difficult. In that sort of position, you've really got to consider what you think is the stronger of the two. And that can be influenced by what news events are coming up, right? A lot of people are not aware of where they can get these news events from. Forex Factory is the one that I normally use. You get basically multiple sites around where you can get what announcements are coming up, and the red flag announcements are the ones you really need to look out for. So I normally have a table of them. I actually have a list beside the computer every week of all red flag announcements that are coming up, what date and time that's coming up, and I put that in my calendar to alert me that there's an event coming up, and to check it and check whatever positions are open against it. Does that answer the question?
It does for me, Matthew. You good? I believe that makes it clear. Yes, thank you.
Good. I'll just change slide now. Let me know when it comes up. But anything else in the meantime? Any other questions so far?
Yes, one more question also coming from Ivan. Although most people don't start with capital that they can comfortably make a monthly income with by only risking small percent of their account. Most people start with small accounts, was at 10,000 USD. Do you recommend these individuals to take the same amount of risk? Basically, I think that the question is, if you start with small account, should we increase the risk that we just spoke about?
Depends on your tolerance for risk, Ivan, and whether you're willing to have an account depleted. All right? This is by increasing risk, especially when you're new. Well, firstly, when you're new, you're more probable of having a losing transaction than a winning transaction. So increasing the risk per transaction can be a very, very dangerous game. It can severely knock your account balance around. I had drummed into me from day one and it's an old cliche, let your profits run, but cut your losses short. And that is minimizing the amount of capital at risk. Personally, I would suggest to new traders take much smaller position sizes until you become proficient, until you've got a success ratio well in excess of 50% successful as opposed to 50% losses. So 60 to 70% of your transactions being successful and 30 to 40% losing. Probably then start to look at increasing your trade risk back up to the desired maximum. Having been through in the industry for 19 years, I've seen many people come in and start, because they want to increase a small account, they'll start taking bigger trade risks and they end up depleting their account, blowing the whole thing up and ending up with nothing in their account. If you've only got $1,000 or $3,000 that you can afford to lose, then you really can't afford to lose that $3,000 or $1,000. So you really should maintain that lower position sizing based upon trade risk. Does that answer the question?
Yes, thank you.
Okay, we got the next slide up on your screen. The cruel mathematics of trading.
We see it, yes, you can go on.
Okay, it's what I call the cruel mathematics of trading. It's how much you lose out of your account and how much you've got to gain to get back to break even. And once you start losing 30, 40, 50%, those percentages of gain become horrendous. If you lose 10% of your account, you're down to 90%. It takes 11% to break even. That's not that bad. If you lose 20% and you're at 80% of your original balance, it takes you 25% of what you've got. You've got to grow 25%. At 30%, you need to make 42% growth. You lose 40%, you're down to 60% of your account balance. You need 67% growth to break even. At 50% loss, you need to be able to make 100%. And at 60% loss, you need to be able to make 150%. Guys, if you've lost 50 to 60% of your trading account, there's no magic switch in your back for someone to flick that turns you into a super trader, which is what you need to be then to recover back to break even. This is why I am risk management anal. Limiting the risk per transaction to me is the biggest single factor in successful trading. If you limit your risk to 1 to 2% per transaction on your actual account balance, theoretically you'll never go to zero because you're risking 1 or 2% on a reducing balance. Is the psychological impact of losing 20, 30, 40, 50% of your account balance makes it very, very, very difficult. It knocks your ego around. It knocks your confidence around. it makes it extremely difficult to be able to concentrate and manage your positions. You're constantly scared of losing more transactions, and that doesn't make you a successful trader. Any questions on that? I'm just changing slides now. Don't know why it's taking so long for the slides to change over. Let me know when trade management is up.
All right, we have one question from Sean. Could there be an example on how to calculate the lot sizes? For example, I have entry signal assuming I have an account size of 10K.
Okay, so I didn't understand some of that, Jordan.
Well, Sean, I think calculating the lot size is really a very basic thing, which I believe it's not the place to discuss, to be honest.
I'm actually going to cover that in a later slide.
All right, so it will be covered then.
So the position sizing, if I understand Sean correctly, he's asking how to determine the amount of the size of the position. Is that correct?
I believe so, yes.
Okay, we're going to be covering that specifically. Excuse me. There are a couple of calculators out there that are readily available, and I've got the web address of one. It's the best one I've found to calculate position sizes. Have we got the next slide up yet, mate? Trade management. Okay. Trade management is looking after and modifying the structure of each trade. Right? The methods can vary based on what type of trade setup was used for entry, or however the trading conditions change within the duration. We could be looking at a trend trade, so a trend reversal. We could be looking at a pattern trade, which is a continuation. We could be looking at just a straight reversal trade, which doesn't give us a trend line break as such, but it's still an actual reversal of direction. We could be looking at a consolidation, which is different to patterns. Defined patterns like flags, pennants, and triangles have specific target rules that a normal, just a consolidation break doesn't have. Inside bar continuation as well. Trade management needs to be based on the setup and the confirmation structure. Right? The time frames that you're working with and different management structures that you have in place. And that should also include, get me out of here right now. Emergency management. When you see something going against you really, really hard, you just perfectly legal, perfectly legitimate. Just close the transaction. Get the hell out. Right? If you've done something drastically wrong, sometimes it's best to close everything off, sit on your hands for a little while, and contemplate and study what happened. Identify whether you could have done it better, how you could have done it better, if you could have done it better at all, whether it was just one of those things that goes against you. Trend trades are managed slightly different to pattern trades. The trend trade is, for example, you've got a falling resistance or a rising support line that you've got a price penetration through. How are you going to confirm that the trend has traded? As a general rule of thumb, when rising support and falling resistance lines are penetrated after they've been applied correctly, because there's a lot of poor application of these particular boundaries, and the support and resistance lines are really a boundary of sentiment. Right? If you look on them as a boundary of sentiment, then you need to look at confirmation structures. Just the straight penetration of a rising support or falling resistance can give you a 55 to 60% probability of being correct. With good confirmation structures, in addition to that, you can lift that probability to in excess of 75% probability of making a successful transaction. That's a 25% increase in success ratio, guys. That's definitely worth studying. Patterns require different confirmation to trends. Your reversals, just straight reversals. There are many different types of reversals out there. Two-bar reversals, all sorts of different structures. I tend to like to use those more at extremities of price action, for example, existing long-term resistance or support structures. And we're going to go into a couple of those later on. But how are you going to manage the transaction? So what stops you get? What stop structures are you going to have in place? Are you just going to use the rising support line for stop? Are you going to have an average true range multiple as a stop? Are you going to use low turning points as they go up as your stop? how are you going to look at doing this? And then how are you going to switch between one and another, should you want to switch? We're going to the next slide now, mate. Have we got any questions?
Still waiting for it. Yes.
Yeah.
New slide came in. Barry, let's direct this question at the end, okay? Because it's a bit off topic. Thank you.
I did a speed test before and it was perfectly fine, so I'm not sure what's happening with the internet, but it's causing an issue.
Well, now we see it, so it's fine.
Okay.
No problem.
When you're doing analysis, you're looking through. I don't know how many different instruments everyone's got. With Forex, I've got 28 currency pairs, the indices, about 8 commodities, precious metals and energies. So, especially when you're learning, I tend to think that people should map out the setup structure for each type of transaction they want to look for, and then analyze all of the pairs just looking for one individual setup structure. All right, so you're looking for trendline reversals. Are you looking for just straight pattern, just straight reversals? Are you looking for pattern or consolidation, continuation type entries? All right. It's really difficult to look through, say, 40, 50 instruments, especially when you're new, and look to identify multiple different entry types at the same time. Some people say 50 instruments is a lot. Up until about 2014, I was looking at 1,300 instruments on a weekly, on the weekends. When you look at ASX 300, S&P 500, FTSE 350, commodities and Forex. So it's and then during the week I was looking at around about 100, 150 instruments a day. So it's not a big issue to go through them 2 or 3 times, just looking for an individual setup structure on each pass. Once you've got your head around doing that, you can flick through them fairly quickly with that individual, just an individual setup. You can flick through them pretty quickly, get through 30 odd pairs in 2 or 3 minutes, and then come back and then just concentrate on a different type of entry. Just makes it a lot easier for identifying the individual entry structures that you're looking for. Changing slides now. Any questions on that so far?
I believe no questions. Can you just move your Epic Pen, the dashboard, to the other screen, please, if possible?
How's that?
Yeah, perfect. And now we see the next slide. Thank you.
Okay. Now, Vlad asked me to comment on stop losses, yes or no. I was taught to, in the words of my mentor, never, ever, 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 ever enter a trade with it until you know exactly where you're going to get out when it goes against you, because it will. Let that sink in for a minute. The emphasis on 5, evers. Never, ever, 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 ever enter a transaction until you know exactly where you are going to get out when it goes against you. Now, if you don't have a stop loss in place, you have to define that. The stop loss is basically a safety net. It's apart from major issues where you can get a gap over the safety net, then you stop and your rising trailing stop. Basically, I used to liken it to high wire artists. Right? When we were 12 and 13 and 14 and 10 foot tall and bulletproof, and we've all been there, if we wanted to learn to walk tightrope and we had a rope slung between 2 trees, 1.5 meters off the ground, and a net set at 1.4 meters off the ground to stop us hitting the ground, we'd have all been comfortable practicing. With a trailing stop, the analogy I use there is when you are confident and you're up at 100 feet, you still want your net at 5, or would you rather have it at 92? Stop losses control the initial risk. You are easily able to limit the initial risk. And if you are not in front of your computer screen and the price goes against you, it's an automatic get me out of here now. The problem with no stop loss I see is that you're exposed to unlimited risk, right? That doesn't mean total account wipeout risk. It just means that the risk is not limited in any way, shape, or form. So if something happens when you're not physically in front of the screen, it can cause you a much bigger loss than you really wanted. With stop loss and trailing stop, I find there's less screen time available, less screen time required. Now remember, I started working in weekly on equities. So you can't be in front of the screen 5 days a week waiting for something to happen. You're only in front of it basically on the weekends to identify stop adjustments and new positions coming up. And then you place your orders and close it down. You didn't have to watch it. With your stop loss in place, your controlled position size, your controlled risk tends to enable you to have larger position sizes. And as a direct result of that, larger profits are available. Right? With no stop loss, prudence requires you to have much smaller position sizes, which limits the amount of profit available to you. Longer time frames work really well as you don't need to watch them continuously. If you're sitting in front of a screen looking at 1 minute charts and you're ready to pull the trigger, or 5 minute charts and you're ready to pull the trigger and get the hell out, then you may think that you don't need to stop. But what happens is it moves quicker than you can react. Unless it gaps over your stop loss will actually limit your loss, and better control your profit capabilities. With longer time frames like H4s, dailies, and weeklies, then it means you don't need to watch them continuously. It means you can adjust your stops during the duration of the trade and walk away and leave it alone. For someone like me who's a social animal, the less screen time I have, the better. Going to the next slide now, mate. Have we got any questions?
So far, no questions. To answer Mandarius, we're going to see examples also. It's wise to close trade before stop loss hit. Is that a question or a statement? Sorry. Question and advice. Okay, so is it wise to close the trade before the stop loss is hit?
Is it wise to? I didn't hear the copy.
Yes, is it wise to close the trade before the stop loss is reached?
Okay. That gets back to defining what the original conditions for entering the trade were, and do they still exist? I understand where that question's coming from. Predominantly, you enter a transaction for a particular reason. It's doing something. It's doing something that fits your parameters of entry, and you're happy with that. If something changes and those conditions no longer exist, yes, by all means, get out. Otherwise, but the problem with that is frequently people sit there and second guess themselves. They see price coming back and they just get out. If you're trading with a trend as opposed to scalping, then you need to allow the trend to breathe. That means it will retrace and it will turn and go back in the original direction, or it'll change direction. And you've got to determine, is this a change of direction or is it a mere pullback? Without those pullbacks and new higher low turning points, you don't have a legitimate value to run your rising support line to. Now, having said that, initially, once you've got your rising support in place, your price action can get steeper and then give you a new legitimate value to run your rising support line to. Doing that and running your rising support through over a shorter time frame because it's changed direction can be quite legitimate, and use that as an exit. But just closing the trade arbitrarily because it's going against you, if it's still fulfilling all the conditions of the actual transaction for entry in the first place, I personally wouldn't close it. I let it run. I define where the exits are going to be, and short of something drastic happening, I let it run. I let the stops do their work. That's what they're paid to do. I'm paid to control, I'm paid to administer, I'm paid to define where it's going, but my workers, being the stop losses, are paid to control the position after that. I install them, I raise them, I adjust them, and then I let them do their work. Very seldom do I interfere with it and second guess myself during the trade itself. Does that make sense?
Yes, thank you.
Multiple targets is our next slide. Let me know when it comes up.
Yep, we got it.
We got it. Multiple targets. It's in some areas it's known as harvesting profit. That is, taking some profit at a certain level to let the balance run on a tighter leash. It's not a strategy I've been a major fan of for most trades, as it limits the profit potential of a trade. But that can depend on market conditions. In a ranging market, it can be a very, very legitimate strategy. But I find when you've got a trend and you get onto a good trend, it totally limits the amount of profit that you can make. Now, guys, you've got to remember, this comes from my background as a trend trader, not as a scalper. It seems to be a more conservative strategy, which does have application in volatile markets, but it is limiting when markets are running and driving hard. It's used extensively within the scalping community, but I personally prefer to let the profits run as far as the markets will let them go. With trend trading, profit targets really do limit your profitability, as they're usually based on a small multiple of the initial trade risk. I know Jordan's commented a couple of times on the reward risk ratios that I've got out of some position trades and trend trades, and if you go for 1.5%, 2%, 3% trade risk, reward risk ratio, you can limit yourself significantly when you're looking at trend trades. When you're looking at consolidation breakouts or range-bound trades, that's a different animal altogether, and the taking profit targets can be quite a valid structure in those sorts of environments. It depends quite a bit, I think personally, on what type of trade that you're in at that point in time. And we're going to have a couple of examples of that a bit later as well. Does that all make sense?
Yes, no questions, so I think we're ready to move on.
Either I confused everyone or I explained it really well. Okay,
position sizing.
Yes, there are two main thoughts on position sizing that I am aware of: percentage risk and fixed lots. With your percentage risk, it's a precise method of trade risk. It's a set percentage of your trading account per transaction. It can be 0.5%, it can be 1%, it can be 1.5%, it can be 2%. There's one specific setup I had trading patterns, and it was a very, very, very precise setup method, and it got me a 96% probability. But it was a very precise setup, and it needed three individual different confirmations. When I got that setup, I would throw 8% trade risk at a single transaction, but only on that particular setup. If I didn't get that setup, I was really limited most of the time to a maximum of 2%, usually about 1.5%. But when you got a 96% success rate, the 8% wasn't really a problem. But the percentage trade risk it's a fixed set percentage of the actual account balance. All right, it tends to be it's more exact. It's a set defined risk, and it's actually the entry and the exit can then be your entry and your stop loss can be more related directly to price action, what price action is actually doing, right? Well, I was taught right from the very beginning to only work on what price action is actually telling you. Learn to speak chart. Work with what price action is actually telling you. It does give you more flexibility in position sizing. It's influenced by the entry-exit gap, which is actually based on price action. It's I just tend to find it's because it's exact. I'm a control freak, just in case anyone hasn't figured that out. I'm definitely a control freak, and I don't like having risk that is not limited in any way, shape, or form. So I find the exactitude of percentage risk comforting more so than fixed lots. Has a fixed lot screen come up?
Yes.
Fixed lots, I really don't like it, but I mean, some people like it. This method is a set number of lots per transaction. It does have limitations. Your risk is less defined. Your entry and your stop loss tend to be based on arbitrary figures to fit the number of lots rather than to price action. And that frequently leads to trades being stopped out early. And what can happen here is if you have your stop loss and your entry they're not actually reflective of what price action is actually telling you at that point in time, you can be taken into a transaction, be whipped straight back out again, and price reverses and goes on to reach your previously defined targets. This is the biggest problem I have with fixed lots. And I'm biased against them. So, but that was again, being a control freak, I tend to like the percentage trade risk because I can work with what price action is actually telling me. A lot of people think that the more pips between the entry and the exit, the greater risk you're taking. Only when you are using fixed lots is that the case. With percentage risk as your guide, then you're actually working your position size around the amount of pips difference between the entry and the stop. So position size rises and falls based upon the width of that gap, the entry-exit gap. All right? Does that all make sense?
No questions.
No questions. Position sizing, has that come up yet?
Yes.
So your position sizing determinations, you need to define your entry and your exit values. Right? You need to be able to look at your price action, define where you want to get into a transaction, and define where your stop loss is going to be. That enables you to determine the number of pips. You merely take the difference between the two values. You look at what risk-reward ratio you see potentially within the transaction, and what ratio, and you compare that to what ratio you need to see to make entering a transaction worthwhile. If you're only getting a 1-to-1 reward to risk ratio and you're only getting 50 to 60% success rate, 1-to-1 is not worth entering. If you're getting 1-to-1, if you see a 1-to-1 reward risk ratio and you are getting 80 to 90% success to failure rate, 1-to-1 is worth entering. These are factors you've got to determine. Determine the amount of account risk in dollars. And then you calculate the position size based above. So for argument's sake, if your account is $10,000 and you want to risk 2%, that's $200 is your determined risk. If you have 100 pips difference between your entry and exit, that means that, say it's a pound USD, and your account is in USDs, you've got to then take a lot size that limits your account risk to 200 USD, which means you can only take 0.2 of a lot. The calculation, you can set the parameters up in a spreadsheet. I prefer to use the calculator off my FX book. It's the best one I've found. We do have a slide for that. The address for that is coming up on the next slide. But the calculation of your trade risk is vital because it works in around your risk management. It's just, doesn't matter how onerous it is, I believe it is something that needs to be done all the time. Now, many people are not aware of the comments section in MT4. Does everyone understand that there is a comments section there?
So far, only one person didn't know about that.
Okay, the comments section is very easy to find, and I find it quite invaluable for doing post-trade analysis. Put your cursor over the bar that has the date, the time, the position size on it, right-click on that, and that will bring up a list of features. Just tick the comments box, and then you'll get a comments section at the end. It's the last column in your trade analysis. So then you've got your profit and loss, but then after that you've got the actual comments that you put into it. For example, with Delta trades, I just put in bear D1H4, D1H1, and bull D1H4 stroke H1 if it comes up as a trade on both H4 and H1s, or H430. If you put those sorts of comments in, you can do a lot of analysis later and find out which are your most profitable transactions, which gives you the higher rate of profitability, as in the number of successful transactions, but also you can look at your overall profit per transaction. The flags, I just put ascending flag. So for me, ascending flag is A flag, descending flag is D flag. And that enables me to just do post-trade analysis quite readily within the MT4 platform. The position size calculator I use is there on the screen. It's basically go to myfxbook.com, and it's the first or second tab across the top. It's got calculators, and just click on the position size. That is a really easy calculator to use. You merely put in your account balance. I'm so used to looking at it, I haven't looked at the fields in a long time. Your account balance, what your trade risk is, either as a percentage of your account balance or as a flat value amount, as in dollar amount or euro amount. The other thing you need to put in is what currency your account balance is in. So if it's in euros, you need to click euros. If it's USD, you need to have it set up for USD. That's the other tab there. Then you put in the number of pips for the trade risk, and then you select the pair. Right, Aussie USD, Aussie New Zealand, Euro USD, USD Yen, and it automatically calculates the actual risk in dollars for you and the lots available, and it goes down to 3 decimal places for platforms that go down to 3 decimal places. It's just a quick, efficient way to develop your lot, to actually come up with your lot sizes. The problem is it doesn't have oil on there. It has some of the other commodities, but it doesn't have oil. With that position size calculator, you don't, if you're looking for for example, a pound USD, when you pull the drop-down window down for selecting the pair, you don't need to scroll down to pound USD. It's the USD that's being calculated. So any pair ending in USD is one you can use. So you can use the Aussie USD, the Euro USD, New Zealand USD, and you'll come up with this exactly the same position size. So you can use that, for example, with oil is one that comes to mind, is readily available. It's not actually in the drop-down list, but all you do is define the number of pips. Now, on oil CFDs, on oil contracts, 1 cent equals 10 USDs. So 1 cent is 1 pip. So calculate the difference between your entry and your exit in cents, and that is the number of pips. Enter that into that calculator, and that will give you what you need to know for a position size on oil on the MT4 platform. Right, a lot of people sit down and calculate, and I haven't figured out how to do it for some of the other commodities. Cotton and cocoa, and those are actually in that drop down menu. The energies are not. So for nat gas, I've still got to sit down and calculate it manually. But for Brent crude and West Texas Intermediate, you can just do it that way. Just figure out your trade risk in cents, enter that as the number of pips, and that will give you your position size. Any questions on that? It's not a difficult calculator to find, but I find it very efficient. Trade entries, is the slide up yet, Jordan?
Trade examples is now.
Okay. The main trade entries that people are using, or that I use, well, let's go back to it. Basically, these are the entries I use. Trendline breaks, patterns, for example, flags, pennants, triangles. Now, double tops, and these are trading patterns. Double tops and double bottoms and head and shoulders are not trading patterns. They are directional change confirmation patterns. Trading neckline breaks in these is very dangerous. All right, but you can trade the trend line breaks, and what the pattern then does is it gives you normally a much higher target to aim for than you're going to get out of the trend line. So that gives you a much higher reward risk ratio. We're going to go through a couple of these. You'll be able to see what I mean by it. Consolidation, continuation, straight reversals. It's just different types of trade entries that I use. The trend entries I define with trend lines, obviously, but I do use the MACD for a confirmation signal of trend changes. It's something I've been using for 19 years now, and it's stood me in very, very good stead. So with some of the trade examples we're going to be using, we're going to go through the whole process of trade management. I'm going to take you through 6 actual trades that have been undertaken. And these are 6 trades that have been undertaken since I started with TAC in May of this year. We're going to look at multiple examples with multiple entries and several trade management levels, right, which will change within the duration of the trade. Trade management methods usually being trailing stops, right? Sometimes you are limited in what you can do with trailing stops until the trend actually gets going. We're going to look at some different entry types based on price action. All right, we're looking at new entries to pyramid interpositions during the trade duration. So once we enter a transaction, if we've entered it at one long-term boundary of support or resistance, there is a very high probability we're going to be able to enter several positions in that same pair within the duration of the trade. Changing trailing stop techniques based on price action is something else we're going to be looking at. And different exit types. Everything I do is regarding applying trailing stops, entries and exits. They're all based on price action, what's occurring, how it is occurring at the time, how I read it.
Seems like we're in the clear. No questions?
No questions? Have we got the USD yen up at the moment? Have we got the USD yen slide up?
Yes.
Okay. Now, many of you will have seen me call the double bottom on this particular one back in early December. The double bottom merely enables us to establish the upper parameters. We've got the 2 bottom peaks here. Can everyone see the cursor on the screen? Let me draw this. All right, here we have our 2. That was a crooked line. And here we have the peak of the valley. So we've got a trend coming into it. We've got a low turning point. We come up. We've got a high in the middle. We've got another low turning point, and the price is coming back. That tells us where, with a high probability, and that probability is usually in excess of 80–85%, that it's going to reach a target, a predefined target, which is this target up here. Can everyone see that? Yes? No?
Perfectly clear on my side, but few people record saying that the drawing is lagging a bit from the sound, so maybe you go a bit slower.
Okay.
Thank you.
So those lines are up there now. We can actually see the double bottom forming, but the entry is off the falling resistance line, the trend break. It is not off the pattern neckline break. So we've got a falling resistance line coming down through here, and based on that falling resistance line, the entry value is here, and the stop loss is here. The trade risk is 28 pips. Now it's at 28 pips that determines the position size. We've seen the price come up. Now, kind of hard to see the MACD there, but I need to see the MACD histogram change from negative to positive at or around the trend line break. I get into some specifics upon what I need to see, but the confirmation, I need to see a confirmation, not just a price penetration of a trend line. Our price has continued up. It has broken through and closed above our neckline. That confirms the double top and confirms that the bar target, which is 113.62 yen, is in play. Our price action has come up. It has retraced and has gone back the other way. That low turning point there, that first one, is really going to make the trend line too steep to be really operable. So then we needed price action to continue up and come back and give us another low turning point. That low turning point there is what I call a major low turning point. We've got two lower highs, lower lows coming into it, and two higher highs, higher lows coming out of it. It's also called a pivot point. That's the one that gave me the trend line application. With a lot of these smaller double bottoms, providing there's no significant resistance immediately above the target level, you will normally get to target 2. So hence the price action came up, penetrated the target line, and I let it go. I didn't exit the position. It was only when it came back down towards my trend line and this bar here, this first red inside bar on reversal, with an open at the top and a close at the bottom of that bar, that was a warning to me. I put the stop loss immediately just below the value of that close. That was where I didn't let the trailing stop behind the trend line take action. I based the exit on price action as it was occurring. Does that all make sense? Can everyone see that chart properly?
Yes, I do see it clearly, but I do have a question, if you guys don't mind. Why did you draw the trend line the way you did it? I mean, you had the initial move up, pullback, another move up,
yep.
Second pullback, and then you used this low there as your point where you draw the trend line. Why not the previous low?
Because that would make your rising support line far too steep. Price only has to move 2 bars sideways, maybe 3 bars sideways to penetrate your trend line and your trailing stop. I need to see a change of direction to give me a trailing stop exit, not just a sideways movement through a rising support line.
All right.
So the trend line would have been too steep. But what I did do, once the price took off in the towards the target again, I raised my stop to the low of that particular initial low turning point.
All right.
So I protected the capital, protected the small profit, but I had no real valid way of drawing a trend line that couldn't have been easily knocked out just by a sideways movement in price. Does that make sense?
Yes, perfect sense.
Okay.
One more question, if you don't mind. What is the best time frame for one to do analysis to determine the support resistance levels, draw trend lines, etc.? This one comes from Joseph.
I personally prefer the longer trend lines. I don't go below H4 because I find the market gets choppier, and I don't have the time to be there every hour or 30 minutes or 15 minutes. So all of my stuff is based upon weekly direction, daily price action, and H4 price action.
All right.
But it gets back to what suits you. I mean, Danny would be horrified going out to daily price action. Danny loves the 1 minute, 5 minute, 15-minute arenas.
Everyone is swimming in his own waters, wherever he feels comfortable. As long as we make money, I believe he's all good. One more question.
Yep.
How do you choose the initial stop loss?
Okay, I use an average true range value either side of the trend line. I use average true range because it is relative to price action. All right, so I use average true range 13. Wells Wilder, who invented the average true range, has a fetish for 14 periods. Every indicator he's invented is based on 14 periods. 14 periods, to me, is an arbitrary figure. 13 is at least relative to Fibonacci. And that's the only reason I use 13 as opposed to 14.
All right. And one more question, please. For trend entry on 4-hour chart, what time frame is good for entry? Example, 1 hour after 4-hour close. I'm not sure I completely understand the question. But maybe
okay,
you do.
I don't use the close. I do not use close as a determination. It is a method that some people use. I use a boundary of what's called market noise. So I run half average true range each side of the trend line as the market noise value. That market noise value is my entry. And it gets back to the original definition I was given of entering trend. You need to see a significant penetration of the trend line. The operative term being significant, and that's what term that needs to be defined. All right, so significant needs to have a definite value on it, which is why I use average true range. So in this particular case, average true range was 28 pips, as we can see here from the trade risk. So my entry was 14 pips above the value of the trend line for that bar, and the stop loss was 14 pips below the value of the trend line for that bar. That was how it was determined.
All right, thank you.
Okay. Now, while we didn't get out at target, we got out very close to it. So that particular transaction had a 75 pip gain with a 28 pip trade risk. So 2.7 to 1 was the reward risk ratio on that, which is not too dusty. It's perfectly acceptable. But I do like long time frames, and I do like longer runs. So let me know when the next slide comes up. This is a good example of a smallish double bottom going to multiple targets. Any other questions in the meantime?
Yes, one more question. Any rules for late entries on trend on 4-hour chart?
Any rules for
late entries, basically? How can we handle
late entry?
Late.
As I was taught originally, it's called BIMI. B-I-M-I. Bugger, I missed it.
Skip it, basically.
Yeah, wait for a new entry. All right, you've missed if you're entering late, you've missed the original conditions for entry. So where are you going to base your stop loss? Where are you going to base your entry? If you just enter at market because you've missed it, where are you going to put your stop loss that's relative to price action without increasing the risk?
All right, we see the next one, Aussie Frank.
Right, Aussie Frank. Yes, many of you will remember the double bottom call on this one back in September. Again, it was a trend line entry, the trend line break that was used as the entry on this. Here is where the price action penetrated the falling resistance line. The trade risk on this was 64 pips. The average true range was 64 pips. So entry was 32 pips above that value of the price bar going through the trend line, and the stop loss was 32 pips below that. On the same bar, the confirmed entry, confirmed the entry for the falling resistance break. It was big enough to close above the neckline and confirm the entry, or confirm the pattern. So we projected the targets from there. So the height here of the pattern was projected through target 1, target 2, and target 3. And for any of you who were watching it, we remember we got to target 1 fairly quickly, and then it just waffled around for 2 or 3 weeks. Didn't do much. Again, the stop was moved to here because the trend line would have been too steep and too restrictive to run off that low turning point there, and it's not a valid major low turning point. It's just a low turning point. Now, going with trends, we're looking for a boundary of sentiment. So a single spike cannot be considered a boundary. We need to look at multiple hits on the trend line, or we need to see a highly specific hit as number 2 hit to give us our reliability for that trend line. So I'm not here to teach trend trading at the moment, but it's more to give examples of how we're managing stuff, how we're working through stuff, and how we're managing the trade once it's entered. So we've let it come down, give us a new low here. All right, so this low turning point here, this green bar is actually, it's got a lower high, lower low than the red bar before it and the green bar after it. So I actually ran that through there as a boundary. Once I got this low coming through here, that gave me a high degree of validity for that trend line, and then price action took off again. We got to target 2 pretty quickly. We got near target 3, then we came back down and gave us another low turning point, and at that point in time I decided to put that trend line through there as an exit in case it came back down again. Target 3 is very important for these small double bottoms. Quite often you'll get to target 2 and indeed target 3. I have yet to see one get to target 4. In excess of 17 years trading in conjunction with these patterns, I have never seen a smallish double bottom like this achieve target 4. They will change trend prior to that, which is why once we hit there, I use target 3 as a take profit. That, guys, that is purely an experience thing. It is something that I've found over many years of working with these patterns. But the important thing is here we've got multiple types of trade management happening here. Once we had the entry here, we got this low turning point. The stop was lifted to this value here, that first low turning point. Then we had an opportunity to put in a trend line, and the stop was running up underneath that trend line. Then we got another trend line, a steeper trend line. We ran the stop up underneath that as a value of average true range, underneath the value of the trend line. Then we hit a target that is rarely exceeded, and I closed the position out based on that. So our initial trade risk on this transaction was 64 pips. The entry to target was 365 pips. Our reward risk ratio on this was 5.7 to 1. These are the reward risk ratios I'm used to trading trends. These are where I personally don't like exiting lowish profit targets when I'm deliberately trading a trend which has a high probability of going much higher than what those low targets tend to be. And that's the only reason. When you're looking at shorter time frames, when you're looking at shorter runs, and you're looking at volatility in markets, the scalping methods, the predetermined lower profit targets are very, very valid. But the trades I'm looking for and most comfortable with and most experienced with are these longer trends. Do we have any questions on that? No?
Seems one question actually. In your strategy, are you using divergence?
No. I'm still learning divergence. This is purely trend line breaks with confirmation from MACD on a trend like that. The next one that we're covering is the Swiss franc yen, which is a different type of entry that I use. But I'm having trouble grasping cycles. It's very subjective to me. So I'm not confident enough yet with divergence and cycles to actually use them. But even so, if you get divergence, you get a divergence entry on a decent trend trade, I personally would still manage it as a trend trade. We're talking about the management of the trade once it's entered. We're not talking about the divergence entry is a different type of entry that I'm not covering purely and simply because I'm not confident enough in the use of that at this point in time.
How about Bollinger Bands? Basically, in general, I believe Arun Kumar is going to the place where he's asking, do you use any indicators at all to confirm your trades?
On trend trades, I use the MACD histogram to confirm the penetration of the trend line. On patterns, I use price action. So I see the pattern developing on a higher time frame. I need to see a specific price action on the lower time frame below that. So if I see a pattern forming, say a flag forming on daily, I come back to H4 for my confirmation. If I see a specific price action within that formation on the lower time frame, that's the confirmation for me. What? A lot of people use indicators. A lot of people don't know what the indicators are telling them. If you're using indicators to confirm price action, for example, the stochastic, slow stochastic. The slow stochastic was built for consolidation breaks. The slow stochastic merely tells you where the current close is as a percentage of the highest high and the lowest low in the last 10 periods. That's all it tells you. The RSI as a confirmation tool on price action merely tells you that the last close as a percentage of the number of up days compared to the number of down days over the last 14 periods. It was built for sideways trends.
All right, one more question regarding the Aussie franc example. How do you set your targets? Is it based on support and resistance?
No, it's based upon the height of the pattern. So you've got the peak of the pattern, and you take a vertical line from the high of the peak in the middle of the pattern down to the line drawn across the two lows. That value is your next target, and every other target above that. So in that instance, I think it was about 100. It was around 100 pips in height of the pattern. So the next target was, the first target was 100 pips away from the high in the middle of the pattern. Then the second target was another 100 pips further on, and target 3 was another 100 pips further on. Make sense? when I show the patterns on the when I post the patterns on the forum, I always draw in the actual pattern, the target height, and the projected targets. I've got all the lines on here because I needed to pre-draw them on these charts for the presentation. It clutters the chart up a bit more, but when I'm posting for example, a pattern in the general forum, the only lines on the chart are the line across the low peaks of the double bottom, the line across the neckline, defining the height of the pattern, and then the target from there. Does that make sense?
It does to me.
Does it make sense to the guy who asked the question?
Yes. We got the confirmation.
Yep. Okay. Chef Bien. That's just, I call the Swiss franc the chef. There's only one letter missing from that word. It peaked at what is a long-term resistance. If you go to a weekly chart on this chart at that peak in September and look backward, it is a significant long-term resistance level. We then had a significant reversal with the open at the low of that bar here and the close not far above that. It is almost a spike reversal. Some people call it a pin bar. The next bar here, we had an open about the middle of the bar. The price came back up, came down and closed nearly at the bottom of the bar. That is a 2-bar reversal. That is a powerful tool when price is bouncing off support, especially long-term support or resistance. That to me is sufficient for an entry. So from there, I just calculated value half. I actually ran the boundary of the sentiment up here off that low. I basically calculated, because the price kept coming, it didn't penetrate where I would want it. And then as the price kept coming up, I raised the value of the entry, still relative to price action. So it's half ATR below the value of this trend line here. So the entry was 42 pips below the value of that trend line, and the stop loss was 42 pips above it. We had a trade risk of 82 pips there. Can everyone see that? So there's the value of the trend line, the day of the penetration of entry of the price action. That's your value. That's your entry. Just there, that was the value of the trend line at that point in time. Now, interesting thing about this one, we didn't have a trend, we had a hard drive down. So there's nowhere to put a trend line on this to run a trailing stop. So I used a multiple of average true range as the trailing stop. All right. What I do when I'm selecting this is I look at the price action, I look at what the price action can do, and what the value of the ATR multiple is that will allow the trend to breathe. I need to see price running I need to see the trailing stop running where the price can actually retrace, can come back to it, and still continue on. This one just takes experience, guys. If you're using an average true range trailing stop, it just takes experience to get your head around it, and it just takes experience to be able to come up with it accurately. We had no trend line. We had no real high turning points to be able to run a trend line anywhere off this price action. All right, if we were to come down here, price action would just go sideways through our trend line, or through what we define as a trend line, and then you get an arbitrary exit. So the average true range came down, it just comes down. As the value goes back up, the stop doesn't move, the stop doesn't move, the stop doesn't move. It came down to here, and then 2 bars later, we exited the trade there. That was how that trade was managed. It was no trend line, no other real value that we could determine to run that trade. So I'm perfectly happy to run a multiple average true range as a trailing stop. All right. Any questions on that? Our trade risk was 82 pips. Our entry to exit was 379 pips, and we had a reward risk ratio of 4.62 to 1.
Just one question. What is the pink line that you're showing? Is that the ATR?
That pink line there, that is the average true range trailing stop loss.
All right. And Barry is asking, when you have your MACD histogram confirmation, does it need to change from negative to positive or vice versa? Or does the MACD histogram just need to be on the correct side of the zero line for the direction it is moving?
No, on a trend change, the MACD histogram has got to change from either negative to positive for a long or from positive to negative for a short. However, because you can have a decent run of price action prior to penetration of the trend line, the histogram can change over up to 5 periods before the price penetration. Outside of that window, your probability immediately drops back to about 50%. Within that window, your probability is between 75 and 80%. But it can be, as long as the MACD has changed over up to 5 periods before or the period of the penetration of the price action, that is the confirmation that I use. Again, that's years of testing.
All right, thank you. One more question. Can you please cover the ATR-based exit once again, just to clarify?
Okay. Average true range is a formula figured out that gives you the actual true range of price action. You've got range, which is merely the distance between the high and the low. But things like gaps are never taken into account when you're looking at actual range. True range is a formula that calculates and takes into account possible or potential gaps in your price action. And there are 3, I can't remember the 3 components of it now, but I use a multiple of average true range. That multiple can be 1.5 times the average true range, which is how that trailing stop is now 1.5, for example, 1.5 times the average true range away from the highs. All right, the price action, if it's a bit more volatile, can come out to 2.5, 2.9 times average true range. So if your average true range, for example, at the top here was 82 pips, at 1.5 times average true range, the trailing stop is 121 pips behind the lowest high. And if price direction changes and comes back to it, say in this one here, the average true range would be that level there. If this price came back up here like this and took it out there, that's how the stop is determined. Does that answer the question? Now, I don't know whether there is an average true range indicator. Have we got any more questions before we go on to the next chart?
Yes, it answers the question. Thank you.
Okay. I don't know if there is an average true range indicator available for MT4. I would be surprised if there wasn't.
Yeah, we do have one. It's actually built in. Yes.
Okay. So all you need to do there is work your multiple of average true range. And again, average true range was developed by Wells Wilder, and his standard default format is 14 periods. And again, I use 13 for no other period than and it is relative to Fibonacci. So in some way, it's at least relative to price action. Practically, it probably makes next to no difference between 13 and 14. Okay, how have we got the Euro CAD up? Hello.
Yes.
Okay. Now, in late August, we had this flag forming in the EuroCAD, but my entry prior to that was based on this.
I meant yes to that. I hear you, but we still see, at least I'm still looking at franc yen.
Oh, okay. So we haven't got the EuroCAD up yet.
There you go. Now we see it.
There we go. Back in August, I posted the chart of this flag here in the EuroCAD, but my entry for the transaction was actually off this two bar reversal here. It was actually lower than the falling resistance line. The falling resistance line would have come through around here. It would have worked out pretty similar, but that was the falling resistance line hadn't reached, or the price hadn't reached the falling resistance line prior to this 2-bar reversal forming. Again, we had decent support around this low here. So that was the entry. It was based on average true range around that high. 106 pip trade risk on that. Then our price came up, we formed the flag, and I posted this flag in the general forum at the time. So we had our entry come off there. We came up. We did not achieve the target. So we're quite a way short of the target. This low turning point here, we've got basically a low here, a low here, we've got lows here. This trend line was run through as a line of best fit. So we've got a slight gap between the lows here and the trend line. And we've got a slight penetration.
Can you go a bit slower because it's lagging again and we don't see the actual drawings going together with the sound synced.
Okay. With the trend line, you can see that the first couple of lows near the trend line, they don't quite reach the trend line. I've run the trend line off the low turning point within the flag formation itself, and you'll see that the next 3 bars or 4 bars have a slight penetration of the trend line themselves. That is what is termed a line of best fit through the price action. The one thing you cannot do with a line of best fit is go past a close. So you cannot have a close on the opposite side of your trend line to the majority of price action. That's the only real definite with a line of best fit. Functioning. Give me a minute, guys. I've got another method.
Peter, sorry, but for me the connection is very, very poor. I can barely hear you guys. Can you hear Peter? All right, Peter, can you please repeat that because last 1 minute was a really bad connection. Let's try again.
You there, Jordan?
Yes, I can hear you now.
Hello?
Yep, I hear you loud and clear.
Hello?
Yes, can you hear me?
Hello?
Hello, Peter.
Yeah. I've just replaced the mouse.
Okay.
My mouse stopped working. I just got another one and plugged it in. Okay. So yeah, going back to this line of best fit. So we've got slight penetrations around where the flag is formed. We've got a low turning point that the line goes to. and we've got slight lows that haven't quite reached the trend line further back down around the original entry value. So we run a line of best fit through there. This, the rising support line, low turning point, the second red bar above that has got a close fairly low in the bar. Your trend line cannot go above that close for a line of best fit. You can have penetration of the trend line by lows or high points on a bar, and you can have gaps to the trend line by lows or high points on the bar on the bars, and that's what I run as a line of best fit. We run off there. The price has actually turned again. This bar, this big red bar here, it closed right in the bottom of it. It was almost an engulfing bar, not quite, but almost an engulfing bar. And again, that's a danger sign. So the trailing stop was lifted to half average true range below the trend line at this bar of penetration here, and our exit gave us 50 pips off the flag. All right, so we exited with 184 pips off the original entry, and we exited with 50 pips off the flag. Our original trade was 106 pips, so off the flag we had 0.5, basically 0.5 reward risk ratio, and off the 2-bar reversal entry we had 1.73. For a trend trade, that's a very small reward risk ratio. That's you tend to on trends, I do tend to look for higher reward risk ratios than that. Any further questions on that?
Guys, is all clear? Any questions? Or move on.
Okay. Let me know when the Euro New Zealand comes up.
It's a long way from Panama.
Yeah, it's a lot colder where you are.
There we go. We see it.
Okay, guys, this is a trend where we have 3 different entries on a single run. We've got significant long-term resistance at the top. Again, we have this 2-bar reversal formation at the top. So long-term resistance, 2-bar reversal is a very strong signal. Our entry was half ATR below the low of that second red bar in the reversal. As you can see from there, the price went back up significantly, started to drop, and it took another 4 bars to trigger the entry. So that order was sitting there for 4 days, didn't do a thing. Our trade risk on the initial entry, on the initial position, was 130 pips. Now, what is interesting here, at this point in time, we have no trend line. We don't get a trend line until this formation here, which is a descending flag, which I posted in the general forum in October. So again, we use the average true range to secure our trailing stop until we had a legitimate point to run the trend line to. And this is interesting because I've got both the average true range and the trend line. The trailing stop on the trend line would be running behind the value of the trend line here, like this. But I use, as I said, multiple trailing stop techniques at once. The actual trailing stop followed the average true range because that was closer to price action than the trend line was. Does that all make sense? Any questions on that? If I have 3 trailing stops running on a single chart on a trade, I will swap the actual stop order entered into the platform is the value of the trailing stop that is closest to the price action. That way I maximize profit when it turns.
One second, sorry to interrupt. Few questions here. So basically, first one, the long-term support and resistance is determined based on daily, weekly, or monthly charts.
That's based on daily and weekly.
All right. Next question. I see on the second bar reversal, there is often a pullback immediately following this. Do you ever wait for the first pullback and trade that breakout, or do you just trade the original break?
I'm not sure what he means by pull back and trade the breakout.
Second bar reversal, there is often a pullback immediately following this. Do you ever wait for the first pullback? I'm not sure I get the question.
Okay.
Also.
If I'm understanding him correctly, he might be talking about pull back, do another high turning point, and come back down again. The entry value was based upon the low of the second bar of the 2-bar reversal, and you'll see all these lows are just testing that value until we get the 4th bar later that breaks through the entry value. Does that answer his question?
Barry, does that make sense? Yes, all right, perfect.
Okay. Then, a few days later, we have this flag forming. Now, the quandary here is, what size position can I take on this? What trade risk do I still have open? Now, because at this point in time, we don't have the trend line in place, my stop loss is now at this value here below the entry. You can see that the average true range comes below the entry value. So that takes my stop down below the entry value. I've got no risk anymore on this transaction. So all the trade risk is off the table from the original entry when that flag forms. And in fact, by the day of the penetration of the entry value from the flag, the trailing stop is down and is now locking profit in. So I can come back to a full trade risk position size on that flag. Does that make sense?
Yes, all clear.
All clear? Fabulous. Now, once we've got the break here, we have a high turning point that we can run as a boundary of sentiment, boundary of negative sentiment. And notice back up at the top, the 2-bar reversal and the green bar, the price jumped back up. The value of the trend line cannot come below the close of that bar. So it hasn't done that there. So I'm running it through here. So I put the falling resistance line in as an absolute boundary, but the trailing stop is running behind the average true range, which is between the trend line and the price action. So the average true range is closer to price action than the trend line is, and that's the basis of the trailing stop loss. Is everyone clear with that?
One question, after the strong reversal bars, why entry wasn't taken after bearish bar after the pullback? Why blue line was the entry at 1.769?
Because that is the average true range value below the 2-bar reversal. So I've still got my market noise significant penetration below the value of the reversal.
All right, thank you.
Does that make sense for you?
No further questions as for now, so
okay.
I believe it's fine.
So now we have 2 full-size positions open in this single rundown. We've got a full-size risk position here at 1.5%. I've got another full size 1.5% risk position size here of the flag entry. Now we're watching price action develop. Excuse me. Price runs down. We see this low down here around the 13th or 14th of November. Then we start getting some consolidation. So price comes up a little bit. It's basically going, it jumps up off a pullback here, but then essentially it's going sideways. This is not a flag, guys. I don't get the confirmation of a flag out of this on the shorter time frame, but it is a consolidation. And as such, you see you've got your price action here, jumps up, and you'll see the range of the movement of the bars is actually compressing as it gets further into the consolidation. So based on that, I'm happy to take that as another entry. The difference between just a consolidation like this and a flag is that a flag gives you a highly specifically defined target or set of targets. A consolidation like this does not give you that specificity. It doesn't give you a defined target. It just tells you that there's a pause in price action and it's probably going to keep going. Does everyone understand that?
Believe so. We have one more question. How you managed to skip the 2 green bar reversal?
Is he talking about this here?
I believe so. Yes. Yes.
That's not a reversal because the low and the open and the close of this first green bar are at the bottom of the bar. That's not a 2-bar reversal.
Is that clear, mate?
Sorry?
All right, clear.
Okay. So then we have another entry here at half average true range underneath the momentum line here. Price continues on. It goes down. Now here is a very, very, very strong signal here. This support here is a long-term support on weekly. We're probably not going to get a run break through that. And then we have a strong 2-bar reversal here. Now see the difference between these 2 bars here and the ones back in this consolidation. The first bar in this consolidation, the first green bar, it's very weak. It's like the open and the close are both in the bottom of it. This strong jump up with this green, the second green bar, is actually a pullback. It's not a directional change. Here, we're bouncing off. Now, I've drawn the line at the extremities of these bars. It's within 10 to 20 pips of the overall long-term support and resistance levels here. But these 2 green bars on this reversal, they are very strong. See how the close is in the top of each bar. We've bounced off long-term support, and we've got closes low in the bar and opens low in the bar and close high in the bar. That's a 2-bar reversal. The stop loss went immediately to the top of the second bar. It was a little bit below. You might be able to see the average true range. It's not really very strong color. I do apologize for that. But if you can see, the average true range is not determining the stop loss, the exit in this place. That second bar of that 2-bar reversal is determining the exit. So the exit was based on the 2-bar reversal. Does that make sense?
Let's wait to see if anyone has any questions.
Yep.
Just a few more seconds. Mr. Tux is saying, please speak more about 2-bar reversals, their frequency and reliability.
Please pick, or I didn't hear the second word of the question.
Please discuss more about the 2-bar reversals.
Okay. A 2-bar reversal. A lot of people will take off the entry. Look at the bar, the first bar of the reversal on the entry. You've got the open high in the bar. You haven't got the high, open is very high in the bar. The close is very close to the bottom of the bar. A lot of people will look at that, especially on a larger bar than this, and just take it as a straight reversal. I personally want to see a confirmation of continuation. Too many times, as we can see in the middle of this consolidation down the bottom, the third entry, you get a strong reversal back like that. Is it a pullback or is it a directional change? On a single bar, it is nearly impossible to tell. So I want to see a second bar with similar strength, as in the open and the close at opposite ends of the bar, continuing in the same direction as the first bar. Is that clear, Tux?
Yes, clear.
Does that answer his question properly?
Yes.
Okay. We can spend more time on it in private message if you want some more information on it, mate. Now, here's something that's going to mess with your head. The exit for this short position, this falling trend, is actually the entry for a rising trend. How many people exit a position and immediately swap directions? It is something that is very, very seldom taught. So that 2-bar reversal there is an entry for a long position. So my entry, it's still an open position at the moment, so I'm not going into detail on it, but the entry is half average true range above the high of this bar. And now we've got the low point here, we've got a low turning point here and a low turning point here. We can run a rising support line through that immediately. Guys, be on the lookout, especially with trend trades. The exit of one trade is often the entry for the next in the opposite direction. Most people close their position and go, that was great, and start looking around for new entries. The next entry on this may well be the exit you just took in the opposite direction. Have a think about that. Go back and have a look at some of your trend trades and see whether you could have actually entered the opposite direction and how much more profitable that strategy would have been for you. Now, how's that for messing with your head? Now, here is the real importance of looking out for these extra trades in a single direction. Our entry to exit on the first entry here off the 2-bar reversal was a 1,114 pips of a 130 pip trade risk. We had an 8.8 to 1 reward to risk rate on that particular transaction. The second one off this flag was another 801 pips of a 135 pip trade risk. It was another 5.93 reward risk ratio. The pound New Zealand is going to show you just how powerful this can be. The entry off the third entry here and the exit, we took 29 pips with 0.21 reward risk ratio. But importantly, we took 1,944 pips out of that single directional run. Just shy of 2,000 pips, guys, from early October to early December, a 2-month run. You can make very, very, very good returns trading longer time frames and have a life. This is why I do prefer longer time frames.
Peter, as we're almost hitting 2-hour mark now, and it's about to wrap it up, before we get to the final parts of the presentation, many people asked me during, in the beginning actually, about your book. Can you please tell us more about it? Is it still available? If so, I'm sure me and Vlad were going to arrange something and post the links, but can you just say a few words about that, please?
Yep. Okay, that book was written based on my experiences. It was never been published, but it was written because I wanted to write it, and it was contracted by 2 brokerage firms in Australia. It's currently, Vlad has seen it, and so has Jordan. They've both read it. Vlad has asked me, I told him I'm doing a 2nd edition rewrite. Vlad has asked me to include some things in that, which I'm doing. I'm partway through the 2nd edition rewrite as we speak. Once that is completed, then it will be available to TAC members through the TAC website. You'll be the first guys to know about it once the 2nd edition rewrite is completed.
Awesome, thank you.
Okay. Any other questions?
All seems good.
All seems good. Let me know when the pound New Zealand is up on the screen.
All right. Okay, delivered. See it.
Okay. This one we had 4 entries on a single run from late September to late November or beginning of December. Again, we had price bounce off a significant resistance level on daily and weekly. Again, we had this 2-bar reversal at the top here. This one was a slightly stronger reversal in that with the 2nd bar, the close was right at the low of the bar. That gives that drive down considerably more strength. And the 1st bar was actually an engulfing bar. An engulfing bar is where the open and the close of the 2nd bar encompass the open and the close of the previous bar in the opposite direction. Does everyone understand that?
Yes, clear.
Okay. Now, something I forgot to do at the beginning of the presentation. I use bar charts for one reason only. They show the same width of the bar and what you would call the tails or wicks on a candle. Bars and candles tell you exactly the same information. They don't tell you anything different. I just find the charts cleaner and less cluttered with bars than I do with candles. And that's the only reason I use bars instead of candles. But they tell you, they don't tell you anything different. They both tell you exactly the same information. Both contain the open, the high, the low, the close. All right. And something I forgot to mention before when people were talking about using indicators as confirmation. You've got 4 pieces of information here on raw data on your chart. You've got the open, high, low, and close. Most indicators are a mathematical manipulation of one of those 4 pieces of information. The mathematical manipulation of one piece of 4 of information can never tell you more than the raw data can. Does that make sense?
Yes, no questions.
Excellent. Okay, so same 2-bar, or a stronger 2-bar setup on the initial entry. Trade risk on that was 196 pips. Now on pound New Zealand, I have had one entry that was 450 plus pips difference between the entry and the stop loss. You can get wide spreads on this one of entry exit gap. But when it runs strong. It is my favorite pair. So we entered that transaction off this 1st bar, breaching the entry line here. The trailing stop didn't move for a few more few more days. The trend line wasn't able to be put in for quite some considerable time. So we were running trailing stop off the average true range for about 2 to 3 weeks before the trend line was able to be put in. But here, part way down, you see this second entry here. This is a slight consolidation. It is not yet a flag. It doesn't give the confirmation of a flag. Your two bars in here are not parallel, but it is, however, a consolidation. And then the next bar after that confirms that again. So based on that, I was happy to take an entry, half average true range below the low of this red bar here. Can everyone see that?
Everyone sees it. Yes.
Everyone sees it. Now, for the sake of clarity, I haven't included the initial stop losses for the next 3 entries. I only included it for the original one. I just felt that the extra lines down here were going to clutter the screen and cause confusion. But I did put the trade risk values in pips in for each of the entries. So then our price drove down. This was the value of our stop then. By the way, at the entry of here, our stop loss was below the entry value. We were locking profit in. I had no risk exposure on this when the second entry occurred. So I've got a full trade risk position here. Everyone see that? The third entry, however, was a slightly different story. The trailing stop had not yet reached the entry of the second position when the entry of the third position occurred. It wasn't far off it, but on this bar of entry here, it was still slightly above that entry. So I had to slightly reduce. There was still a bit of risk on the table from this entry here. So this position here on the third one was slightly reduced. This goes back before to what I was saying. When you get a new entry, if you've still got risk on the table from the previous entry, reduce the size of your second entry so that your overall exposure, your overall risk is still the maximum you're comfortable with. Don't ever get uncomfortable with risk exposure. It'll cause you problems. So we've got basically a flag here. Entry off that was off this bar here. Off this high here, we were then able to put in our falling resistance line. So I've got half average true range above the rising support line, and I've got the average true range multiple running here. So I could swap between these two as a trailing stop, which I did when it got down here. You can see the trend line, the average true range of the market noise of the trend line is actually lower than the stop from here. So we had 196 pips on our second entry. We had 213 pips trade risk on our third entry. Our fourth entry, again, we've got a strong consolidation here. This is essentially a sideways movement. The base price is basically contained between those two horizontal lines there. I'll get rid of some other stuff and just draw them again. So basically, the price is contained in there. It is a consolidation, and I'm happy to take that as a new entry. Trade risk on that entry was 222 pips. All right, so The stop loss at that point in time was well below the previous entry. We had no risk on the table. We're protecting open profit at the moment, so we've got a full size entry on that fourth entry. Very interesting. Our trend line ran through here. Price action came up, touched the trend line, came back down. Our average true range stop is here. It is almost at the market noise level above the falling resistance. The exit of these positions was based on the falling resistance break here. The average true range, it's difficult to see on this slide, is not quite as low as the market noise above the falling resistance line here. That is the basis of that exit. So we're using multiple entries and multiple exits. We're swapping around to what the market is telling us is happening. This is a vital part of my original education. Learn to speak chart. Look at what the market is telling you. Think about what's happening. Think about what's occurring. Now, here's one to actually seriously mess with your head. In a 2-month period, from late September to basically the beginning of December, our first entry yielded 1,588 pips profit. 196 pip trade risk. We had an 8.1 to 1 reward risk ratio on that. Our second entry yielded 1,141 pips trade profit. 196 pip trade risk, again 7.19 to 1 reward risk ratio. Our third entry, 338 pips, 213 pip trade risk. We had a 3.93 to 1 reward risk ratio. Our fourth entry, we only got 201 pips out of that. Damn shame that. Trade risk 222, 0.9 to 1 reward risk ratio. Guys, that 2-month run yielded 3,768 pips in total profit off a single trend run through multiple entries. How's that for messing with your head? Excuse me, I just had to have a drink.
Too easy.
No, it's not easy. It's not easy. It takes a lot of work. It takes a different mentality, a different psychology to what a lot of people are used to.
Well, for me personally, if I can jump in, holding a position for such a long period, I do come from investing style as well. I do have long-term trades as well. That's for sure, and I still do it. But keeping a position for 1 or 2 months, it is something that can get to you, especially if you're used to the lower time frames, such as the 4-hour chart or 1-hour chart entries, where you just have entry, exit within a few hours or days.
The longest trade I have ever held was a shade over 18 months. On weekly time frames. There was 82 periods, 82 weeks I held that trade open. Why did I hold it for that long? Because it was running basically it was running within boundaries of trend without penetrating the trend line. It was continuously making profit until the end, when it turned and bounced, took out through the trend line. I don't have a problem holding a trade for a long period of time if I've got a valid exit strategy that does not get triggered. So if the stop loss doesn't get, if the trailing stop doesn't get triggered and the price continues in the original direction, I do not have a problem holding it for any length of time, and I do not have a problem re-entering new positions within the duration of the original trade.
Speaking about all that, and now that you covered basically the whole chart, we do have a few questions here.
Sure.
So if we might start, the first one is, how did you determine the entry line at 2.0092, basically at the top?
How do I determine the entry line? What, sorry?
Yes, how did you determine the entry line at 2.0092?
Okay, we've got this 2-bar reversal here. I take the value of the low of the second bar, which I've just drawn a line on. It'll come up for your screen in a minute. And then the entry is half average true range below that low of that bar, and the stop loss is half average true range above the low of that bar. And that's what gives me the trade risk of 196 pips.
Sean, clear? All right. Another question is just to clarify the stop loss.
Just quickly, Jordan.
Yes.
Jordan's got to go and pick up his child from school in the not too distant future. I'm happy to stay here and take questions until he has to go, or until he needs to actually shut things down and has to go. If we have to shut down and stop questions, it is because he has to go and pick up his child from school. Just so everyone's aware of that.
I think we have enough time to cover all the questions.
That's fine.
I believe this is the last chart, right? Last example?
That's the last chart. There's just 2 more slides.
All right. So one more question is just to clarify, the stop loss is calculated using ATR 13 and 1.5 multiplied ATR, if I read that correct.
Not okay. The multiple of average true range is something that I vary to fit the price action itself. That takes experience, guys. There's no one size fits all with this. Sometimes 1.5 is just not enough. When the price is volatile, 1.5 is far too small. You've got to come out to 2.5. I've even been out to 3.2 in some instances, because that's what I had to do to accommodate the volatility in the price action. On this, most of the time I'm between 1.3 and 1.8, but I tailor it to fit the actual price action. To describe how you do that is really intense, because it does require a lot of experience working with the indicator and just seeing what works. You get a feel for price action and you get a feel from where you can start. And I normally start out a bit wide. So if I'm thinking 1.5, I'll normally start about 1.7. And if price does what I hope it does, then I'll close the multiple back in a bit. But it's how to determine the multiple. It just takes experience. I'm sorry, there's no quick fix for that.
All right, thank you. One more question. Long-term trading, when it comes to that and holding positions for such long periods, is your account swap-free?
No.
All right. So basically the profits are overcoming the swaps and the commissions we need to pay, and then at the end of the day, when we draw the line, it just makes sense.
All right, 1,600 pips in a single downward run is going to vastly overwhelm any swap you've got.
So basically, those are all the questions regarding this chart. So I believe we can move on.
Excellent. Okay, basically, guys, we're going to be assembling a full question and answer manual, which will be uploaded to the website. If you've got any other questions, or you think of anything else later, or you run through the webinar again and you come up with new questions, please submit them. It will help everyone. We can answer any questions that you have in the manual, and there'll be questions you haven't thought of that other people come up with. So any questions, submit them. It's going to take a little while to assemble the manual, because we need to allow time for others to watch the webinar, guys and people who weren't able to be here for the actual time this morning. So as soon as we have it available, the guys will be assembling the questions, sending them to me. I'll be putting them together in an question and answer format, and I'll be grouping the questions around, as I understand them, around the flow of the webinar. So if a question comes up about risk management, that will be relating to the slide on risk management. So that will be basically section 4 in the manual. Trade management will be section 5. questions on the actual slides will be back down at section 20, 22, 23, 25. So please submit any questions you have. That's about all I can think of, guys, unless there are any other questions. Thank you very much. I do hope it was enjoyable. I do hope you got something out of it, and I do hope you're able to benefit from some of the things you've learned today.
Absolutely amazing. Everyone is saying here, thank you, very interesting. Wishing you Merry Christmas, of course, and all the wonderful wishes which I'm going to pass on to you later on.
Have a great break, everyone.
Also, on the behalf of TAC, the whole club, Vladimir, me, of course, would like to thank you for your time, your valuable information, and all this research gathered during the years. I know how painful that could be, especially back in the days when we didn't have easy access to computers. It was probably all manually drawn, hours of manual work, etc. So I really appreciate it. And as you said, all the questions, guys, if you come up with new questions, please send them over to us. We're going to pass them to Peter, and we're just going to organize them in a nice, beautiful PDF, which would be available for everyone later on.
Beautiful may be a subjective term.
I'm sorry, what's that?
Beautiful is a very subjective term.
Okay. Sleek.
But you did bring up an interesting point, Jordan. Going back 20 odd years, 20 plus years, before computerized programs were available, charts were drawn by hand. I have actually suggested to every one of my students over the years that you take one or two instruments and you do it off end of day. Don't do it off 4 hourly, it gets too tedious. End of day or weekly. Manually draw a couple of charts for 3 to 5 months. It is tedious, but you will develop a feel for price action that you will not otherwise accumulate. When you have to, in fact, weekly is a very good one to do it, and do it at the end of every day, because you actually get a feel for how price is developing within the bar. Forget its weekly bar, forget its a one day changing of it. It could be working off 4 hour bars with a 1 hour change. But that's just going to get too tedious. But it helps you get a feel for the development of price action as it's occurring. And it's just a feel you'll never develop unless you physically do it by hand. Yes, I know it's tedious. I did it for 9 months, and I did it across 7 different charts.
And now I feel too young. Young and spoiled by technology.
I tell you who was young and spoiled is everyone who started trading in the last 10 years. Back when I first started trading, we only had brokers. Online brokers were a thing of the future. We were paying 2.5% of the transaction value for entry and 2.5% for exit. You had to make 5% profit on an equities trade just to cover your brokerage. You haven't made any profit yet. When people start bitching and complaining about half a pip or 2/3 of a pip difference in spread between brokers. Something that I look for in a broker, the main thing I look for is execution. It is much more valuable to you than half a pip or even a pip difference in the spread. The actual speed of execution is the key in a broker for me. It serves you nothing if the speed of execution is that you lose 2 to 3 pips on every transaction because you want to save 1 pip on the spread. Think that through, guys. The speed of the execution.
Vice versa. Spread is much more important because usually execution nowadays, I almost never had issues besides the moments during very important news.
And also some of your market maker platforms will have slow execution.
Maybe I didn't come across such brokers, luckily.
Well, Ava trades a market maker. But the reason why I have an account with them is because they have very high speed execution. I've dealt with market makers in the past that have very slow execution speeds. And that wasn't in the too distant past either.
What can I tell you? I'm thinking about what you said about you must be doing 5% in order to make money back in the days.
Yep.
So for me, that's a very good motivation, actually.
Oh yeah, yeah. You weren't just throwing money at trades every day. You were really sure of what you were doing.
So for you, now it must be super easy.
Oh yeah. Well, no, you still got to be on your toes. I mean, one thing, the psychology of trading is something people don't really address. You can end up being very cocky. I know I'm arrogant, but I'm arrogant only on subjects about which I know a lot. So if I come across as arrogant on something, it's because I do know a lot about it. But I'm not cocky in how I set up the transactions. I don't just take transactions. I still go through the whole complete identification, confirmation process. It's something that was drummed into me from day one, and it's something I've never let go of.
All right. So guys, I think that would be all. Let's close the webinar now. Thank you all for attending and for the wonderful questions. Again, Peter, thank you very much. Happy holidays, everyone. And we'll keep in touch in Telegram. Thank you, guys.
Happy break, everyone. I'll be on Telegram most of the days, pretty much every day. If anyone wants to have a chat, just let me know. Hit me up on there. Hope you've enjoyed it. Hope you got something out of it, and have a great day, and we'll chat later.
Thank you. Bye-bye.
Bye, guys.